The Kalshi prediction markets agree, by the way, with Hassett now back ahead of former Fed Governor Kevin Warsh, who took the lead, I think, just this week. Hassett leading the odds today with a 53% chance of getting the nod, Warsh down to 34. While the market debates which Kevin could win the horse race, we wanted to ask what would be the real difference between them as far as the market can discern. Let's bring in Dan Clifton. He's head of policy research at Strategas. Dan, the task goes to you. I'm sure everyone is asking you about this as well. Is Hassett viewed as more dovish on the margin, and is the market kind of responding? I wonder, even literally the 10-year dropping a bit today, is that because his odds seem to be down in the prediction markets as well?
Well, first, Kelly, thank you for having me on. I think the conversation we're going to have on the Fed chair is very much related to the conversation you just had with Steve and Diane about what's going to happen on economic growth next year. And we do anticipate that GDP will accelerate. We have $400 billion of fiscal policy. Fed's cutting rates. It's expanding its balance sheet. I mean, this is shock and awe fiscal and monetary policy coming for 2026. And what we know is that when you go from the first year of a president to the midterm year, you get accelerating growth, you get rising bond yields, and you tend to get a much more defensive and declining stock market in mid-year. So all the ingredients are there. But what happens is once you get that growth, the Fed has to pull back on the punch bowl. And that means that you're going to have the new Fed chair appointed by President Trump facing accelerating growth and likely going to have to put the brakes on this. You can just see how this is going to play out mid-year. And the good news is that you have two very qualified candidates. You have Kevin Warsh and you have Kevin Hassett. I think even if you add Waller in, who I think is the best central banker in the world right now, you have three good choices that are on the table at this point. Both of these candidates, Kelly, both Kevins, believe that we're in a productivity boom, and that boom is going to allow the Fed funds rate to go lower. And if you look at some of the employment data that came out today, the higher unemployment, wage growth down, that may argue that the neutral rate has to go a little bit lower rather than just being right around that neutral rate. Maybe you got to be a bit stimulative here. And the reason is that we're in an air pocket. And that air pocket is that we're getting all the spinach from the tariffs without that fiscal policy sterilization. But as you go into 26, you will start to get that sterilization happening. That timing difference is making data look weaker. And it's also showing that the Fed probably should have been cutting rates a little bit sooner. So yeah. I tend to think that the difference between those two are going to be more on the balance sheet than it will be on the rates. But maybe, it's like one rate cut over another. It's really not going to make a bigger difference on the rate side. But it's the balance sheet where you'll start to see some of those differences show up.
For what it's worth, Nancy Lazare had a big note over the weekend where she details the productivity boom and agrees that we could be in the middle of one. We've had strong data for several years now, so you can certainly make an economic case for that. What do you think, then, are there differences on the balance sheet?
Yeah, so Kevin Warsh has been very hawkish on the balance sheet. Doesn't believe the Fed balance sheet should be where it is. You just heard from your other guests, there might be a case for that. But what's happened is that this is intricately linked to financial regulation. When we regulated the financial sector, we closed off a lot of bank reserves. So right now, there's not enough bank reserves in the system.
Right.
It's why the Federal Reserve is expanding its balance sheet. This is not a one-way case. What the Fed is doing right now is that they are expanding their balance sheet to fill in the gap until we get to financial deregulation in 2026.